Here we go, here we go, here we go, here we go. Welcome to the Fed live stream. Let's go. What's going on, everybody? This is the blockchain backer bringing you the latest cryptocurrency news and analysis. Welcome to the Fed live stream today on July 30th, 2025. This is where we watch to see what happens to the market once the Fed rate decision comes out in the next 4 minutes from right now. So if you were watching this on replay, you can skip forward 4 minutes and be able to see what the market did the second the rate decision came out. And then when Jerome Powell comes up to speak in about 34 minutes from right now, we'll see how the market reacts. So if you're watching the replay, skip forward 34 minutes to be able to see how the market behaves as Jerome Powell speaks. During these events, I always like to give a little bit of disclaimer. During these events, the price can be incredibly erratic, and many times the first move is not the real true move, or it can be, or not, or it just goes one way aggressively, the other way aggressively, and then ends exactly where it began. So there can be a lot of volatility during these. There can be a lot of fake out moves. There can be real moves. We just kind of have to roll with the punches while they do happen. I don't usually provide any commentary on them because they can aggressively change and be all over the place. So the way these things tend to work is here in the next 3 minutes, we'll be able to see the statement released over here on the Federal Reserve's website. So this is their June 18th release, and we'll sit here refreshing this page to see if when they come out with the updated FOMC rate decision. The current forecast by the market is that they will not be cutting rates today. So if your expectation is that they will be cutting rates today, the market does not expect that that will be the case. They put a 96.9% probability that we will not be cutting today. The interesting thing is the market does have keeps shifting about a 58% probability that we will see a cut at the next meeting. So a lot of the focus is not going to be so much on what actually happens during the rate decision, as the expectation is that it will remain paused, but what the forward guidance looks like. So what we tend to see is a very indecisive Jerome Powell who has mastered the art of being evasive to questions, not answering questions, dodging, and typically just saying, I don't know, and we're waiting for more data to come through. So if he gives any type of clues that are different from, I don't know, we're just waiting for more data to come through, there may be something to read into in that. But that has been what we have gotten from him for many, many meetings in a row. So it's been quite frustrating, quite annoying. But we'll see how the market does react to all of these things happening. So the first thing coming up is in about 30 seconds, we're going to get the rate decision, and then we'll see what the immediate reaction of the market is. So then I'll explain what it's like as we wait for Jerome Powell to come on stage and what this thing down here is. And we'll go into all of that and talk about that after we see how the market initially reacts. So we'll find out here in just a couple of seconds. So it says about 4 seconds until we see a market reaction to the actual rate decision. And what do you say, market? Must not be loaded on here yet. There it is. Maintain the target range. So no change. See what the market does. Nothing crazy to the market just yet. No immediate pop, no surprises. This is exactly what the market did expect. And it's interesting because we can always look at this, but many times we actually also get the clue just by looking at yields over in here. This 2-month yield has pretty much been precise for whatever is going to end up happening. So the 2-month yield also told us we were just going to stay there at that 4.25. So let's see, July 30th, they even started with the same thing as swings and net exports continue to affect the data. That's really how they started this one, although swings and net exports have affected the data. Okay, we'll go ahead and dissect this thing and see if there's any type of clues that are given in here. The initial reaction to the market, again, now that we have a couple of seconds, is still just flat. So no major moves coming just yet. Although swings in net exports continue to affect the data, recent indicators suggest that growth of economic activity moderated in the first half of the year. The unemployment rate remains low, and labor market conditions remain solid. Inflation remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance on monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. It was as bland and as boring as you could possibly have expected. So last time, what did we get? Although swings in net exports have affected the data, recent indicators suggest the economic activity has continued to expand at a solid pace. Economic activity has continued to expand. Recent indicators suggest that growth of economic activity moderated, right? So they're acknowledging there's been moderation of economic activity, whereas in the last one they were saying, no, we're still growing. The unemployment rate remains low and labor market conditions remain solid. Inflation remains somewhat elevated, right? This is today. Last time, the unemployment rate remains low and labor market conditions remain solid. Inflation remains somewhat elevated. It's always very subjective when they're using these words, somewhat elevated. What is it, like 2.8% or something? It's completely within historical norms at this point. So we'll see what they end up saying here when they come on stage or when Jerome Powell comes on stage. So this was to be expected that we would actually just have a pause. It's what the market did predict would be that, and yields also implied that it would be the same thing. The question will be whether or not there's anything that comes out of Jerome Powell to give an indication that we are going to end up cutting in the future, and if the market feels like it wants to rampage into that. So right here on the screen, what you see is we've got the Russell 2000 on the top. We've got Bitcoin here on the bottom. Over on this one, I've got gold on the top, and I've got the US dollar currency index over here on the bottom. You'll notice here on the bottom left of the screen, I've got the live stream of Jerome Powell. So the way this works is in about 26 minutes. So I'll make this a little bit bigger, and then we're just going to watch how the market reacts to Jerome Powell. If you're looking at this and you're saying, "Oh, that's red," no, we're doomed. Many times the first move is actually the false move. So we'll see if that ends up being true. But what we'll do is once Jerome Powell does come on stage, I hit play on this thing. We watch the live stream together, and then I shut my yapper and I put myself on mute, and we just watch it. Like everybody, I just kind of sit back, chilling, seeing how the market reacts at the exact same time. Because I just like everybody, I have no idea what the market's going to do during these meetings and the volatility that erupts during these things. When we get to the end of it and Jerome Powell gets off stage, we wrap things up pretty quickly. We let the market keep going for the remainder of the session. We see how it does in overnight. And then, of course, we check in with it with a video tomorrow morning to see how markets are doing. But oftentimes, we see a lot of the things that we've seen recently where there's volatility leading up to this day, there's volatility during this day, there's volatility the day after. And then, of course, the market's also not just hanging their hats on this event. The market's also looking towards, I don't even know if the market cares, frankly, but you have the other thing going on Friday with Trump's tariffs, right? So Trump's tariff deadline is on Friday, August 1st. What's interesting about that, of course, is when we had the initial deadline back on April 8th, I believe, the market was scared into that event. Then once the deadline happened, the market rallied into that. But right now we're at some pivotal moments here for all markets heading into this meeting right now. So we'll see if the market gets the juice that it needs to actually go into a breakout because it's at major resistances. You have the Russell 2000 back at the 786 Fibonacci retracement level. I took the fibs off here just so it would aesthetically look a little bit better by having both of these in here. But you really do have the major last retracement level sitting right up here for the Russell 2000. So breaking through here would likely be a big deal. And then also with the Dow Jones Industrial Average, it is also bucking up against its all-time high. So we already have the NASDAQ and the S&P 500 in all-time highs, but you have the Russell and the Dow Jones sitting at major resistances. So right now it's, can we get the juice to actually bust these things out? And if we do get the juice to bust those things out, of course, can we finally get Bitcoin to leave this range? Pull off one of these bad boys, there's probably another correction, and then we go in for our parabola for the final move of the market. But at this point, we are still, of course, just stuck in here. We're waiting for something to show up to give us the actual juice to bust out of here. Seems like this is as good of a thing as any, or is it going to end up being Friday's events? We'll see. I'm kind of just an observer with you guys right now. You guys know my thoughts on what I'm looking for in the market, just the timing of it and how it's going to happen, what's going to be the narrative, what's going to build the excitement, what's the catalyst. There's no catalyst out there for the market, which is bizarre, right? There's nothing to suck people in yet, right? And there's always a catalyst. There's always a news narrative to suck people in at the peaks. So we're still just waiting to see what that's going to end up being and if it's going to end up being this. So... B had asked, remember, for 25 months, he had said cuts or no. I tried to answer that before we actually, I was reading what you had said and I tried to answer that before we went into it, that it was unlikely that we're going to see cuts. The big thing the market hasn't done in quite a while is price in that there would be a cut next time. So that's the big thing that we're looking at right now is if Jerome Powell is going to come out here and be dovish talking about cuts, or if he is just going to be the exact same guy he has been, or he is not willing to give any type of answers. That's kind of where we're at. So, yeah. And of course, before the live stream start, Chief Tane Blackbeard, again, gave out 20 memberships, and that was unbelievable. He's been doing that every live stream. I came out of nowhere, started doing that, man. I really appreciate it, and I'm sure everybody in the chat who gets that really appreciates it, brother. Thank you. When I saw that before the stream started, I was like, oh my gosh, again. Thank you, man. And then Jordan Norval said, hearts from the candy liquor, whatever that means. Thanks, man. Free Kip says, I think we have bots in the chat. Yeah, when you get this many viewers, people do that. They try to push meme coins and stuff. Crypto Student 99, thank you very much. He says it's been a while, but life has been busy, as life sometimes gets. Thanks for all that you do, and your consistency to the community that you have grown. We appreciate you. Much love. Oh man, this is very nice. Thank you. Yeah, thank you. And like I'm looking, I'm really trying to think ahead when it comes to this. So this may be a major announcement. I don't know. Maybe a major announcement. It's not really a major announcement. We've been doing the Fed live streams for a long time. I don't know when we started them. But, if we kind of the market's kind of rebounding here right now. But, if we kind of get through this and if we start actually getting like an actual cutting cycle starting, next Fed meeting, September 17th, very realistic. That's actually going to be our last Fed meeting. I just been kind of thinking about it. It's kind of like, like we do this. We started these things waiting for the Fed to make like a really big change in their direction, right? And if they finally get into it, they'd finally just start cutting. That may end up being the last one we end up doing, right? It doesn't change anything else, but it's just like, is that going to be our last one? That one might end up being our last one. But Crypto Student 99, brother, thank you. It's good to see you. Lil Ramirez had super chatted as well. Thank you very much. No message, but just super chatted. Thank you. Belush said, I love the XRP movie that you made. It was very inspiring. Thanks for everything that you've done for our community. Yeah, it took almost 2 years to make, and then it sat on the shelf for almost a year. It was a big moment to finally get it out. It's kind of relieved it's just out. XP Market says, oh no, last FOMC. Well, not this one. It's just next one. If they actually cut in the next one, right? I think it's what we're all waiting on, right? If the cutting cycle begins, then I'll be like, all right, we finally made it. It was like a milestone to get to it. That'll be it. I'm sure there's 1,000 other streamers who would love to pick this up and do the Fed FOMC live stream. But it was just kind of the goal when we started this was, when are they going to change tune? Like everybody, I watched Jerome Powell, and I'm just like, this guy's a total dingus. Why are we watching this? And a lot of you guys tune in to hang out and watch it too, but because we know it can like impact markets, right? And so it's just the same thing. I'm not a huge fan of like Fed stuff, right? But we know this is like a volatile part of the market, and like that changing of direction of the Fed is probably the thing that like gives the blow off for the market. Pete says, BCB, if you make crazy money this cycle, will you quit your channel? That's a great question. No. In years past, like when I started the channel, so I started the channel in like November of 2019, and it was kind of just like this thing, like it just blew up. Like I didn't think it would blow up. And come 2020, like we're entering the bull market, and it was kind of like, I don't really know. I don't really know what I'll do. But as the years progressed, it really has defined who I am as a person, right? Like when the computer screens turn off and stuff like that, I'm certainly not walking up to my children saying, hey. Or when they go to school, have a good one. When you look at things that like you've built in your life, right? And like, things that you're proud of and that define you. And this is something that I've built and defined who I am, right? And so like I just kind of look forward to like the next year, what the next year is like. I think it's more of like what I really want to do is write a book. And I want to do it more just for my kids to hear this story, while it's still fresh on my mind of what it's been like to be on this journey throughout here. Because when my kids get a lot older, they're going to look back on it and realize how weird it was that dad was this YouTuber, that wasn't normal. Right now, they're just young. They just figure that this is what dad does. But like when they become adults and life gets hard, right? And they're trying to pay their rent for their apartment and trying to make money, and it's not easy. And they look at this. I would just like to have that story there for them to be able to read that. And so that's like when I look out to what the next year of life looks like for me, it's that it would probably end up being, we drop down to like 1 to 2 YouTube videos per week, right? A lot less activity probably on X, but it would just be primarily, still continuing the newsletter, because that's where I can like formulate my whole like view of the market. But then the primary thing in the background is working on the book. Trent, that's very kind. That's also been a big thing about life that I'm learning right now in the midst of this moment. This is probably the most exciting moment in the market in a very, very long time. And Trent says, prayers for you and your family. It's definitely not easy to put on a front and hold it all down for your wife and kids. Yeah, yeah. I've had the luxury of the last 6 years of doing this YouTube channel where there has not been really any turmoil outside of the YouTube channel, right? But I'm getting a really good lesson in life of what it's like when there's a tornado spinning, and then you come onto the YouTube channel and things like that. And again, a reminder for everybody, man, like literally none of this money matters. It does not. Your family matters the most. And it's so cliche, but sometimes you have to get some reminders in life to remember that. Yuli asked me something about some type of something. I've never heard of those before. Brian Simcoe says, any updates on your 20 cryptos on your lists? Is there anything lagging you would cut from the list? No, I'm not cutting anything. Like, these things can, with crypto, it can just ricochet really fast. But it kind of becomes, what do I think is going to go into an all-time high and what do I not think is going to go into an all-time high? I have my opinions on that now, right? Like, as time has progressed. But no, just because they can ricochet so ridiculously in environments like this, right? Because you're looking at percentages, and we always talk about that. Percentages mean everything, prices do not, and how much they can ricochet. No, but what do I think is going to go to all-time highs? I have an opinion. Ryan Chase says, I bet you won Lulu that Jerome does a rate cut today. Oh, Ryan, I'm sorry to tell you this. You are late and you have already lost one Lulu. No cut. Rates stay same. We already know the rate decision. They did not cut. So I will take your bet. But you are generous enough to provide enough to probably buy a Lulu. Thank you. BCB Padawan for 25 months says, I watch because... Let me turn my audio off. There we go. I watch because I get to hang out with the BCB, the 702 crew, and listen to BCB's silky voice. Yeah, and that is one benefit of this live stream, is that by the time... Let me see if I adjust this. By the time we get here, my voice is a little more developed. There's a big difference in my voice between morning voice and afternoon voice, which has already been talking all day. So I get it why singers have to warm up their voices. YZ says, do you think ADA will go to 12? Well, if it breaks out and goes into an all-time high, that's the 4.236 extension of the range, right? Will it get there? Guess as good as mine if it's going to be one that actually expands. Does it have a statistical higher likelihood? Yes. And I've gone through all the data on that. So, but if it's only a retrace, I'm willing to cut it at a retrace. It's fine. Vlad Ponzar, it's been a while, man. Thank you. Still here 8 years. Well, the channel's been around for 6, but you've probably been in the market for 8. Brother, thank you. Thank you. It's very generous. All right, so just to give a little update here, we are 10 minutes away from Jerome Powell coming on stage. We're pretty much just burning time watching the market right now. There's been no cut. It's all about what will Jerome Powell say about the future. The market predicts that we will see things happen come the next meeting, but we're going to see if Jerome Powell is going to pull off the exact same stuff he's been doing, where he's very evasive. But Vlad Ponzar, brother, thank you. Shiva Blaster, were you a Pokemon or Digimon guy? I was a Pokemon kid. Gino says the Pelosi Act just passed out of committee 8-7. Congressional ban to buy stocks is getting closer. Yeah. I don't know. We'll see. I mean, they would have to. Jeez, Andy, man. Okay, let me address this because we do have over 3,000 people in here, and then Andy, I'm going to get to that. Thank you, brother. Where we're at right now is Jerome Powell is going to come on stage in 9 minutes, and when he does come on stage, I'm essentially I pretty much have had this maximized the whole time, so I'm going to leave it here, and then we'll play it, and then I will be quiet. And then we're going to see how the market reacts. You'll see this line right here for the Russell 2000. It's just because I wanted the color coordination to work here. But this is a big resistance here for the Russell 2000. This is its 786 Fibonacci retracement. So we're right bucked up against it. This is kind of a breakout zone. The Dow Jones Industrial Average is in a very similar boat as well, as it's bucked up near its previous all-time high as well. So it does just seem like there's one more move in here to be able to get the Russell and the Dow to break out. I don't know if this is going to be the catalyst, or could it be Fridays when we get past the new tariff deadline, right? When Trump pushed it back. I don't even know how many times he's pushed it back, or if it's the original date of pushing back. I'm really unsure. But we've got multiple things to try to get through right here, and we're trying to see what event can it be that can get us out of here. So we'll be keeping our eyes here on the Russell and Bitcoin. Less important so much as gold and the dollar. These things just, I've gone into the dollar detail a lot in markets in the morning. It's, even if it's bottomed, you can take months to double bottom. And that's exactly how the market played out in 2021. And we've seen that exact same thing happen so far right now. Gold, right? Gold just chilling. It's just been waddling sideways in here. It's lost a lot of the steam of what this parabola was moving up in here, as it's just been ranging throughout this. So we'll watch the gold, we'll watch dollar, but more importantly, I think it's about watching the Russell and watching Bitcoin, as Bitcoin has just been stuck in here. And of course, we're all just anxiously awaiting for this thing to finally be able to shift its way out and for us to move on to another phase of the market. And then enter into a parabola of euphoria. And the question is, will we do the same thing as we did? Oh, it would be helpful if you could see what I'm talking about. There you go. Did I just do a bunch of talking? No, you guys could see everything when I did it. That was fine. Of course, we're just waiting to get beyond this one, right? And so we talk about markets in the morning. You have a leg, you have a 702 retracement for B leg, and then you do have a C leg. Was that good enough? We're still waiting for evidence for it to go busting out. So is this going to be our event? Is this the retail hype dream that content creators love to push, right? The money printer meme. We'll see. We're waiting for Jerome to come out and speak in 6 minutes to tell us so. But a little bit of improvement in prices throughout the crypto market since this morning when we were streaming. I think XRP was like 304, now it's at 313. And none of that really matters. We're really just waiting for an actual bust out to end up happening. So when he comes up on stage, I'll be quiet. We'll put this on. And I do have the frog locked and loaded and ready to go. But you guys are always like, oh, just play the frog anyway. At the end, nope. It's only if this market busts out. So Andy Philpott, brother, he had gifted 50 memberships. You guys have been like very generous, and Andy, of course, has been very generous throughout the years, man. And you've done that many, many times. Thank you very, very much, brother. Thank you. Very kind. Misty X Jason, member for 18 months, said ready for the ride. Yeah. Oh, yeah. My wife said I'm supposed to tell you all, lock in, chat. That's apparently the cool thing to say. There's your sound bit. JP Estrada says, is it just me, or is the anticipation of JP coming out at a higher level this time? The market is just waiting for permission to go. Euphoric. I'm locked in. I don't know. Are we more intense? I don't know. I don't know if we are or aren't. Be freaky, brother JB. Thank you, brother. You've been around for a very long time. Thanks, dude. Be freaky. Bingles. Thank you for the super chat. John Shugart, member for 20 months. SBSB, what's your gamer tag on Black Ops 6? Play some games. I do keep that private. To keep that private. But you know, I like this. I like to play the small map mosh pits. It's totally a thing we do in bed. Okay. O says, tell your wife we are locked in. Yeah, yeah. I apparently with kids this day and age, you know, teens and stuff like that. That's what they all say to each other. They like walk up into their crew in their group and say, "Lock in, chat." So I'm just, you know, I'm cool. Ahmad says, how about a farming channel after the bull run? Yeah, I don't know. Look, the thing about YouTube, right, for anybody who wants to make a YouTube channel, just make content about the stuff that you are a nerd about. Your hobby. Make it about the thing that you are passionate about. Don't force it to be anything else. Make it exactly about what you are an expert in. Whether that's gardening or that's coin roll hunting or that's Legos or whatever it is that you nerd out about. For me, I was just spending all my time looking at these charts all the time. I'm passionate about it and made videos about it. And that passion came through the channel, right? And that's the same way with anybody who's like, if you make something that you're passionate about, well, guess what? Like gardening or something, there's other nerds out there who love gardening and they're looking to watch somebody who's as big of a nerd as they am. So just make a YouTube channel totally about whatever it is that you love and that you don't mind spending all your time looking at. So, okay. We are a minute and 30 seconds away from Jerome Powell. So give me just a second here. I've got to get my audio fixed. Let me see. I'm going to... What happens? Okay, good. That's going. Now we'll turn desktop audio on. And essentially the market's kind of like right back where it was before this all happened, right? So we're kind of at square one right now of no real change here in the market. How are this looking? Gold just slightly down, DXY just slightly down, RTY a couple of points, but it's really just where it's been all morning. Bitcoin kind of just where it's been at all morning. So I think the big event, of course, is going to be Jerome Powell coming up here on stage and speaking. So here in about, the expectation is about 30 seconds. I'm going to turn the mic off. I'm going to go quiet. We're going to listen to Jerome Powell speak. We're going to watch how the market reacts. You'll see me bounce around every once in a while, going back over here to gold and the dollar, but staying here mostly on the Russell and on Bitcoin. And we've got cryptos here on the right side of the screen. And then when he's done speaking, we kind of just come in here and just wrap it up and get on with our day. So here we go. Ladies and gentlemen, Jerome Powell. Yeah, there's a horrible intro. He didn't even come through the door yet. So it's not silent. We're just waiting for him to come through the door. All right, you're killing me, Powell. Here, I gave you this killer intro, and then you don't even come walking through the door. You're late. They might have... Oh, there he is. Okay. Ladies and gentlemen, Jerome Powell. Okay, that's not good. Why don't they have any audio coming through their stream? Oh, because I need to turn it
and
on.
Stable prices
How about that?
for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer-run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September, monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be the way the economy reacts over time to, slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I don't think, I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that. And it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, you know, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that, where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all of the discussion of how they're going to, if the companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer-term rates, like Treasury rates. It might be 30-year rates. It might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things, though, going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, but then that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. I mean, we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Chris.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. It's, as I mentioned, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right, so we don't again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you, I'm sure, know. And the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I won't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the US economy? Thank you.
We're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But we really need, the government data really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that, but if we what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us, and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Chair Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper-income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level. And delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate. But it's true, and it was, again, right in line with what we expected. the GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can be can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this dissent, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor forces is just a great deal slower, and those two things have slowed more or less in tandem. If you look at things like I mentioned, quits. Look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So we have an economic go around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go around all the way around the table. Everyone gives their views. So the discussion around policy was the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that for the reasons that they're going to express. I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. But that's the story, and I would say well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock. And it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. I said that's why we think policy should be restrictive, is because inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal. So you have to, that means policy should be tight because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, more a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Jeff Cox.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but GDP is bumpy quarter to quarter, half to half, and often gets revised, after the fact. The labor market data we still think is, continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation because you're being pulled in 2 directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not going to say that. No, I just think we're going to need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're going to make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
Greg, Rob, for the last question.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
All right. There we go. Well, the market did not like that. How about that one, man? Holy cow. So in summary, once again, absolutely nothing out of Jerome Powell. Once again, there were just like the stock market was getting hammered during all of that. Look at that. The NASDAQ bounced back. Dude, the whole thing went super red during that. It was like a liquidation happening throughout the markets. The dollar popped up. Silver, how are you? I saw silver down over $1. Silver's down $1.25. Gold's down $50. Huge moves happening throughout all markets. The crypto market went wild during that. Crypto market's bouncing a little bit now, but it was like there was like a climax happening right there in the middle of Powell's speak. I think I saw ETH get down as low as like 26 50. XRP, it could have hit the twos. I don't know. I only saw, I did see 3.00 at some point, but it looks like market's kind of bouncing back a little bit now that this is over. But holy cow, market absolutely hated that. Of course, the market had priced in that we would be seeing a rate cut during the next meeting, but Powell did everything he normally does in regards to avoidance and aversion from any types of questions. Things that, he said, of course, the housing market's weak. There is weakness showing up in the market, but then turning around and selling it as, we're doing great. We're talking about like the first half GDP was like 1.8% or something like that. And then, saying, oh, but the market's not acting like what it would be if it was restrictive. So the market does not trust him, it appears. But what were other highlights, man? Just absolute avoidance. One other thing, correct me if I am wrong, but he was only on stage for 45 minutes. Isn't he normally on for a whole hour? I need to go back and check our live streams and see how long they are, but he cut it very short, if I'm correct. Normally he's an hour. So we'll see how the markets do react here in the coming day or two. And of course, Friday comes our tariff deadline. And we'll see what markets do between now and between then. There's a little bit of bounce from what was going on maybe 5 or 10 minutes ago. And then we'll see what this thing does. But dude, did you hear all the stuttering he had and the lack of answers he had to questions? And boy, market didn't like it. All right, but throughout that, of course, Andy Philpott was coming in here and dropping little stickers and stuff. Thank you, brother. No, I'd ask, would you buy our 20, 30-year treasuries at these rates? I don't buy those long duration ones. Skeleton had said, love you, my guy. That's all. Purple Tie from B. And Joshua at T88, sure, Powell the Bozo. Yeah, it's just the same kind of stuff, right? So we'll see how the market ends up closing today. Of course, we'll have a video out tomorrow. There is a little bit of bounce happening, at least in the crypto market, since he's got XRP just hitting 305 right there. But metal's taking a really big hit on what's going on in there, and stocks really all over the place. How are you doing now, stocks? Yeah, I mean, Dow was down like 350 at one point. Mind you, these were all green when he went on before he went on stage, or before this all started. So market did not like what he had to say, and we'll see how the market reprices itself and what the market sets its expectations at moving forward. So it looks like these odds, at least right here, are starting to drop already for a cut happening at the next meeting. Either way, we'll see how the market digests today. And then, of course, Fridays are a big day when it comes to tariff deadlines. But again, zoom out. I know when we zoom in on these things, that's what you guys like to see. Here's our zoomed out view. Right. So, all right. We'll check in on this stuff again tomorrow. Guys, thank you all so much for tuning in. Thank you so much for watching. I think if there's anything else I have to say before we get through it, I don't think so. That's it. Thank you guys so much for watching. If you could, please like the live stream and give it a thumbs up. If you're new to the channel, please subscribe and hit the notification bell so you can be notified of when I create new content and when I go live. As always, this is not investment advice and I am not a financial advisor. But if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. We're going to be okay, guys. Have a good one.